You're talking about £1 trillion of savings on behalf of tens of millions of people. It's absolutely critical for that cohort of people that are now coming up towards retirement, where this sequencing risk comes in. There's the opportunity for industry transformation. The solutions just aren't there.
To understand why this is critical, let's say I'm 80. I'm healthy. I've got years ahead of me. 20 years ago, I retired. I invested regularly in a pension, and I even had more money than anticipated the day I retired. The markets had done so well. It felt great. But today, it's my granddaughter's birthday, and I struggle to buy her a gift because my pension savings have completely run out.
And this is not a theoretical example.
There's this great example. Broadly, if you started in 2000 and start with £1 million and you take out £50,000 a year, and you increase the amount you take out every year with inflation, and you invest your money in the stock market, you run out of money after about 20 years because the first thing that happens is you have the tech crisis, right?
Yeah.
And your money, your equities plummet in value, but you're taking out this money every year, which is going up with inflation. And then you sort of recover a bit for a couple of years. And then you have the global financial crisis. And so then you really hurt. And then by like 2012, like markets do fine from 2012 to 2024, 2025. Markets have been great, but it's too late because you've already suffered the loss.
So now the year is 2026 or maybe 2036. You're retiring, you're invested regularly for 40 years. The market has done better than you could anticipate. You expect to live many more years. How do you make sure that you don't run out of money?
And so this kind of sequencing risk really, really matters.
We can hope it doesn't happen, but we can't be unprepared if it happens.
You've got to go and find assets that have the right characteristics of relatively stable value and relatively high income. You don't need the best total returns. You just need stable returns. And so that points you towards different sorts of asset classes. For example, income paying equities, high income equities, equity strategies that use guarantees to prevent really big drawdowns, like structured type guarantees, credit assets that pay, high stable values, asset-backed securities, CLOs, things like this, right? You've got all of these asset classes that have those characteristics. They're available to the sophisticated big pension schemes, the master trust, the DB schemes, but your retail pension investors can't get to that.
Going back to a hypothetical example, you could imagine that it's 1999 and that you have pure foresight and you could tweak this pension. This is not even theoretically possible now because we have moved on to a defined contribution system where individuals are essentially in charge of their pension and are empowered to make their own decision. So the solution has to be for them.
Bill Sharpe, the founder of the Sharpe ratio, big Nobel Prize winner, he said that this kind of decumulation problem is the hardest and nastiest problem in finance. And it's very hard because you don't know anything. You don't know how long you're going to live. You don't know how much money you're going to need. You don't know what markets are going to do, and you don't know what order they're going to do them in. And then the other problem the retail investors have is most of the funds that they use pay withholding tax in the fund. And so if you buy global equities with high income, you end up giving away 0.5% a year in tax. And that's very painful.
This is where we are today, where market climbing is actually an increasing risk, and an aging population has to take full responsibility for its longevity risk. And it's a problem that the sharpest mind in finance struggle with.
It's a real challenge for individuals, and it's a real opportunity for the industry to evolve what they're doing and bring much better solutions to market, and to really develop solutions that are way cheaper, that have much lower tax leakage, much greater flexibility. We look after the assets for pension funds. We put them into underlying investments across a range of asset managers, a range of different types of assets, private markets, public markets. We can use derivatives. We can use all sorts of things to build portfolios. When it comes to that actual take the money, make sure it's invested in the right place, that's the piece that Mobius is doing. And it's all around technology. It's around regulation. It's around cost and tax efficiency, so that money doesn't get wasted, and money is in the right place at the right time. Once you get into the retail pensions world, into these SIPs, that's where it's really about things like tax efficiency, where our solutions are potentially much more tax efficient than what a lot of people are doing today.
So what Hugh is telling us here is that the solutions aren't out there in the market, but the plumbing can be put together. So Mobius is not going to be the architect, but it's a call to action for builders.
We've got a lot of choice, we've got a lot of funds, we've got a lot of technology, we can build things for clients.
And if you link it to the great wealth transfer between the boomers and the generation that follows, the most pressing issue for the wealth management industry, then you see that if you don't build the architecture to solve decumulation, there's actually two risks. The one that your clients actually will melt down due to sequencing risk, but also that their successors will move on to firms that offer better solutions.